Hi class, welcome to lecture 3.1. This is based off of chapter 6 in your textbook. Once again, I've listed a whole bunch of practice problems from this chapter. You can use these for practice, they're not for a grade, and you can obviously do all of them if you want to have an extra challenge. Chapter 6 is all about interest rates, and as you can see with these slides I've given you a little bit of a outline across the top of the slides that will tell you what all we're going to discuss, but we are definitely going to go over the cost of money and interest rate levels, what determines interest rates, how the yield curve is structured, and how we would possibly get future interest rates. Now, before we dive into all the nitty-gritty details of interest rates, let's take a look at a graph that shows both long and short-term interest rates, specifically from 1972 to 2013. And there are some really interesting observations. The first observation that you should see is that long-term interest rates are usually higher than short-term interest rates. Now, why would that be? Well, obviously, if I'm going to hold a bond for 10 years versus holding it for 1 year, or maybe I even hold it for 30 years versus 1 year, that I'm taking on a lot of extra risk because a lot can happen, over the next 30 years. So because I'm bearing that risk, I would like to be paid a little bit more. So this gets back to the idea of risk versus return. And so usually what you will see with a yield curve or, with interest rates is that you will get a higher interest rate for the longer the term for the rate. So throughout most of this time period, you'll see that blue line for the long-term interest rates is above that dark brown line. And you can see around 2006 it was actually they were both the exact same, which was somewhere in the neighborhood of 5 to 6%, and the yield curve was what we call flat. Now when the yield curve is flat, then you're not really getting paid any extra for being long term. This was when I was a bond trader, and so during this period of time I decided I would develop a short-term portfolio because I saw there was no point in investing in long-term bonds if I wasn't getting an extra interest rate for doing so. And so I developed a very short-term portfolio where my bonds turned over all of the time. And make a long story short, I got a bonus that year for doing really good, and I outperformed my benchmarks. The only problem is that bonds lost money that year. So everybody lost money, I just lost less, and for that I got a bonus. And that's how the real world works. You can also see a steep drop in interest rates after the recession. And so right now we're in a period where you have really, really low short-term interest rates. That's why you got a lot of people refinancing houses or buying mortgages at all-time low interest rates. Right now, both the long-term and the short-term interest rates are at extremely low periods in history. What's also interesting is if you look all the way back into the 80s, there were a few moments when the short-term interest rates were higher than long-term interest rates, and so you have somewhat of an inverted yield curve, and this is not normally usual, or I should say what usually happens, but nonetheless, you need to really understand what's going on with interest rate. For example, the inverted yield curve that you occasionally saw during the 80s, it was really just indicative that the long-term outlook looked very poor and that the yields offered by long-term fixed income would continue to fall. Now, to understand how to take advantage of different types of yield curve structures in the market, you first have to really understand the basics of interest rates. And so we really want to dive down into the basics and build upon that foundation. Now, here's a good question for your exam. What 4 factors affect the level of interest rates? So here we have production opportunities. In other words, are there any cash generating assets that you could invest in? And the potential of these projects is what could lead both sides of an equation here to demand for more money or more return for bearing that risk. So, if you have an idea like Facebook and you really think that it could, take over the internet and become the world's leading internet website, then, you could have people invest in this idea and expect a really high return. But because there's never been another Facebook, then there's also a lot of risk involved as well. So if Mark Zuckerberg, just like in the movie The Social Network, went to some investors and offered them maybe stock in the company if they would help get the company off the ground faster, then those would those stocks would be an investment for these venture capitalists, and that whatever they got on that stock would be their return on their investment, right? And so that is something that is equivalent to interest rates. Now, everybody also has different time preferences for consumption. So, Mark Zuckerberg needs those funds immediately, but there are investors out there that have lots of money that don't need, that those funds immediately. Then they may be able to invest in, Facebook and wait and see what happens with it. And that's where you have a lot of, angel fund type investors or venture capitalists will do this with their money, whereas other people may, like me, may not be able to do that because I don't A, have that much money to begin with, but B, I might need my money back much sooner, right? So you're giving up some liquidity here, but that's because different people have different time preferences for consumption. Some people need to consume now, and some people can wait to consume later, and you usually call those people savers. But return is only half of the equation. The other half is always risk or uncertainty, right? And risk, at least from a financial perspective, is the idea or understanding that any investment might provide a low or negative return. I mean, in other words, if you think about the dot-com bust, for every Facebook, there was a whole lot of companies out there that didn't actually materialize into anything, right? You know, MySpace comes to mind as a direct reference to Facebook, right? Why is MySpace not Facebook, or as big as Facebook? Well, there's risk involved, and so a lot of people might have invested in MySpace and it went nowhere, whereas Facebook made, just about anybody that got in it early on in the deal very wealthy. Finally, there's also inflation, right? And inflation is just the amount by which prices increase over time. Usually it's based off of the consumer price index or a basket of goods, like goods you would buy at grocery stores or, at Walmart and things of that nature. And but now inflation can also be different for different types of products or services, right? So, inflation, although it's remained, pretty stable and low over the last few years, there are certain areas that have seen enormous amounts of inflation, such as healthcare and education. Daycare costs also come to mind. Um, Even some, K through 12 education costs, especially on the private side. So, education and healthcare have seen enormous inflation, whereas, maybe, the price of milk has not seen as much. And we've even seen where things like gasoline have actually kind of gone down, at least over a shorter period of time. So once again, those four factors are opportunities, time preferences, risk, and inflation. If you look here at figure 6.3 in your book, you're going to see a relationship between long-term interest rates and inflation. Now, inflation is measured by the annual rate of change in the consumer price index, or the CPI, and then the long-term interest rates we've seen before. There was a small period in the early 80s where, and maybe the late 70s, where you had inflation actually above the long-term interest rates, and this is what got Jimmy Carter in some trouble and scared a whole lot of people because we had really high inflation rates. But as you can see, basically from Reagan on, we've had pretty reasonable inflation rates, and in fact, we even had deflation one year following the Great Recession. Now, the reason that this is important is because if you can look at both of these at the same time and take the difference, that could be what we would refer to as the real rate, right? Because if you're getting a return on an investment, or you're receiving some kind of an interest rate, but you also have a whole lot of inflation, then your purchasing power may not have changed that much. So the bigger the gap between the long-term interest rate and inflation, the more your real rate, for of return really was during that period. And there's actually a neat little equation that we'll talk about this as well, and it's called the Fisher equation. Now, with the Fisher equation, To understand it, you need to understand, what is being considered within the Fisher equation. Think of big R here as it's going to represent the nominal rate, or as we were talking about before, that nominal rate is like your APR or your annual periodic rate. This is just your basic rate of return that you're going to see. However, you also need to consider what the real risk-free rate of interest is. Okay, so what would you have made if you take out inflation, or what if there was no inflation? And then you also want to consider the risk-free rate. That's what you would get on like a treasury bill. Some people use LIBOR. That's basically the London Interbank Offering Rate. But for most people, for the risk-free rate, they use the treasury bill, the 90-day T-bill, and that's just basically what you should expect to get, what kind of return you should get for not bearing any risk at all. So if you think of R as the required return on a debt security, you've got all these other determinants that are going to play a role. And if you notice, you've got the real risk-free rate of interest, and then you've got premiums for all the different things that we talked about before when we were talking about determinants of interest rates. But here we get a little bit more specific, and we label them as very specific numbers. So you've got an inflation premium, which you'll see as H in the Fisher equation. You've got a default risk premium. What would happen? What are the chances that a company or somebody might default? A liquidity premium. How quickly can I get cash out of this investment? Maturity risk premium. This could be obviously a issue with what's going to happen between now and maturity. And so you'll see that R here, or the real rate in the Fisher equation, is going to be all of those combined, except for, notice one is missing, and that's the inflation. Okay, so the real rate is going to be all of them with not including inflation. And just to look at specific types of bonds, you can see that there's two government bonds here, the treasuries, and two corporate bonds. They all have to worry about inflation. The maturity risk premium is going to be more important for the long-term bonds, so that long-term treasury and long-term corporate. The default risk premium is obviously going to be more important for the corporates, where if the government defaults, we're in much bigger problems, right? So we don't really have to worry about it there. And the liquidity premium more for the corporations as well. You can get rid of T-bills pretty easily. Now let's move past the determinants to term structure. What we're going to find out here is that there is a variety of different types of yield curves that you can have. And as you can see, this if you look at the x-axis here, we're tracking these yield curves over about a 30-year period. So you've got like 0 to a couple years there is the short term, and then up to 10 years would be the intermediate term, and then from 10 to 30 is what you would consider long term. And you can see that the yield curves look slightly different at different times. Obviously the yield curve was a little bit more flat around year 2000. It actually went down in 1980, and it looks more traditional right now in 2013, except for the fact that obviously the rates are really low. Now also look at the numbers, right? So the rates are really low here recently, and they were more kind of at what we have traditionally expected in that kind of 3 to 7% kind of range for bonds or whatnot. So we're kind of more in that range there in 2000, and interest rates were extremely high, even though they were somewhat inverted in 1980. So how would you go about constructing a yield curve? Well, the first, you've got to find the average expected inflation rate over years 1 to n. In other words, this is just average, right? So you get the inflation for all the years, add them up, divided by how many number of years, and there you go. So for example, assume inflation is expected to be 5% next year, 6% the following year, and 8% thereafter. How would you go about calculating it? Well, it depends on how many years you look at. If you're just looking at 1 year, then you're obviously just looking at that 5% number. If you're looking at 2 years, you would have added 5 and 6% divided by 2. If you're looking at 10 years, you're going to add 5 plus 6%, and then 8 years of 8%. If you're going to do 20, you're going to do 5 plus 6% plus 18 years of 8%. And so that would tell you, you're just basically getting averages, right? And once again, this is important. You've got to beat inflation or your purchasing power didn't change any, right? So, if I make 100% return on my dollar and now I've got $2, but the price of milk went from $1 to $3, then I actually lost purchasing power, right? So that's kind of what we're talking about here. Now let's take a look at step 2 for constructing a yield curve. We have to find the appropriate maturity risk premium. Okay, so how do you go about doing this? You just use the equation below, 0.1% times t minus 1. And so this is going to be a smaller part of the yield curve, but it's an important part, as you'll see in the next graph. So here in figure 6.5, there's not a, I don't want to confuse you too much. What I want you to see here, though, is that you've got a base real risk-free rate, and then there you got a big chunk of the yield curve is going to come from that inflation premium, and then a smaller part is going to be from the maturity risk premium, and that's really all I want you to really see here. So let's look at an example with the maturity risk equation. And you can see as you add more years, that you're going to get a higher number, right? So a maturity risk premium for 1 year is nothing. But if you are looking at a 10-year bond or a 20-year bond, that obviously is going to grow quite a bit. And so that it's a linear equation here. In other words, this risk premium is going to increase as the time to maturity increases. And that's really designed that way on purpose, right? This has to do with time. So obviously as you add the amount of time involved, this risk premium is going to get larger. And then with step 3, what we're going to do is add the premiums to R. And by R, I mean R with an asterisk, which is the real risk-free rate of interest in this situation. So, okay, so to get the risk-free rate here for these treasuries, whether it's like a 1 year or a 10-year or 30-year, you just add these 3 different components together. So we're going to assume 3% for the real risk-free rate of interest, and that would be like what you might expect on like a 90-day T-bill. And then we're going to add in the inflation premium, which we calculated for each one of these, and also the maturity risk premium. And then you arrive at what you would expect to get for each one of these. Okay, that's pretty neat, right? So this is how you can mathematically figure out what you should be paid for, investing in these particular debt instruments. And so this is what you would get for a hypothetical yield curve. And as you can see, once again, we've got the real risk-free rate built upon an inflation premium and a maturity risk premium. And you kind of would expect it to rise over time like this. And so an upward sloping yield curve is what you normally expect. Not because of the real risk-free rate. That should stay pretty much stable. But you expect that inflation premium to grow over time, and also that maturity risk premium to grow over time as well. All right, there's a lot of words on this slide, but basically all it's saying is you got to also, consider default risk and liquidity risk when you're thinking about the corporate bond yield spread. For example, just take a look here at this table, and you will see that if you look just at the interest rates you should expect on different types of treasury bonds, like a U.S. Treasury is 0.83%, AAA corporate is 0.93%, AA corporate is 1.29, and a single A corporate is 1.67. If you subtract each one of those from the one before it, you will see the spread and see that it is growing over time. And if you look in that far right column, it shows you what that spread is between that particular investment and the original U.S. Treasury. In other words, you're adding risk here, right? And so you expect to get a higher return for doing so. For example, look at this graph here. It's going to show you the relationship between corporate and treasury yield curves. You definitely expect the government bonds to give you the lower rates, and then you look at the AA rated bond, and then you got these triple B rated bonds. So as you go down, anything below triple B is going to get into what we call speculative bonds or junk bonds. or high yield bonds. So you're expecting to make a higher return or a higher interest rate on these investments because you're basically taking on more risk, which is what you'll see directly in the numbers below. Not only does their credit score matter, which is what these ratings are all about, but also how long you expect to hold it. So both with as the the default risk goes up, and also as the years to maturity go up, you would expect to get a higher interest rate. Okay, with pure expectations theory, basically this theory says that the yield curve depends on investors' expectations about future interest rates. So the yield curve can go up, down. It can bow. It can do basically whatever investors expect it to do, really. Now, there are some assumptions of pure expectations. So there are three major assumptions of pure expectations. First, we're going to assume a 0 for the maturity risk premium. That kind of makes sense because there's not a lot of maturity risk if you're dealing with very short-term treasuries. Second, to get the long-term rate, you're simply going to take an average of the current and the future short-term rates. And last, you can pretty much figure out what the expected future interest rates are by backing out of the yield curve, assuming that the pure expectations theory is correct. So I know you got some information there that didn't get a really thorough explanation. The reason for that is I think it's a little bit easier to explain with an example. For instance, look at 5 years of treasury rates here. If the pure expectation theory holds, what does the market expect will be the interest rate on 1-year securities 1 year from now? And then what else? What about 3-year securities 2 years from now? Okay, well, let's take a look. So here's an equation you can set up to figure out the 1-year forward rate. So what you're going to do is you're going to use that information that you got in the previous slide to figure out the 1-year forward rate. And so, for example, the 2 years rate that you saw was 6.2%. So if you add that to 1, you get 1.062 because you had to convert it to decimal first. You square that because it was for 2 years. Then that's going to be equal to 1 plus the 1-year interest rate. So that's why you get 1.06. And that's going to obviously be timed 1 plus x. And you want to figure out what that x is. So the pure expectation theory says that 1-year securities will yield 6.4004% 1 year from now. So it's basically just plug and chug once you've set it up. We obviously just used a simple geometric average, but you could also do this with the arithmetic average, and you're going to get something very similar, 6.4%, which is almost the exact same thing. Let's do another one. We had 2 questions there, so let's look at the 3-year security 2 years from now. And so in this case, what you're going to do is if you think about 3-year security 2 years from now, you're really talking about 5 total years, right? So you use the 5-year interest rate number, and that was 6.5%. So you're going to put 1.065 for 1 plus 6.5%, raise it to the 5th power. It's going to equal 1.062, or that's the 6.2% interest rate converted to decimal plus 1, raised to the 2 power. And then what we're looking for is the 3-year security from that year 2 to year 5 range. So that's going to be 1 plus x raised to 3. You're going to solve for that, and the pure expectations theory says that the 3-year security will yield 6.7005% 2 years from now. Okay, so mathematically, that's how the pure expectations theory works, and hopefully that made more sense. So what are some major conclusions about pure expectations? Well, a big conclusion here really has to do with the market risk premium. So we were assuming that the market risk premium was 0, but we know over time, it's probably true for every one of you as well, for me, is that we all would rather hold something short term than long term because there's a lot of risk involved over time. And if you're going to hold something for longer term, you expect to be rewarded for bearing that risk. So if you look here, this is going to be a major problem why the pure expectations theory might be wrong. Investors are logically going to demand a premium or something to encourage them to hold these long-term securities. In other words, the market risk premium should be greater than 0. And then finally, on this last slide, I just want to point out a few macroeconomic factors that are going to have an impact on the interest rate. Uh, the Federal Reserve policy, federal budget deficits or surpluses, international factors, and level of business activity. And all of these, for a variety of reasons, can have an impact. So, for example, with the Federal Reserve policy, you're dealing with the money supply, and the Federal Reserve is naturally going to control that. Obviously, we've seen that happen here recently, with the Fed's kept the interest rates extremely low as of late, and there's no doubt that that's kept interest rate levels at an all-time low. Specific terms you might hear are things like quantitative easing. Right now, the Fed is actually backing away from that quantitative easing, and most predict that we're going to start to see these interest rates begin to rise. Federal budgets and deficits or surpluses actually matter a great deal too, because that tells you how much our government's going to have to borrow, which is going to change the supply and demand structure for interest rates. International factors can play a big role too, especially the foreign trade deficit. In other words, is a country importing more than it's exporting? And the reason that that matters at all is because the higher that trade deficit, the higher the tendency for that country to have to borrow, right? And then finally, business activity can have a huge impact. It can have an impact on inflation levels. It can also have an impact on short-term versus long-term interest rates. For example, during recessions, short-term rates decline more sharply than long-term rates. One of the reasons here is it goes back to that Federal Reserve policy. The Fed is actually going to play a bigger role in the short-term arena than in the long-term arena, whereas long-term interest rates are going to have be more of a reflection of inflation, or average expected inflation rate over that next 20 to 30 year period. Nonetheless, all four of these factors, and you could probably throw in a couple others, will play a big role in the macro economic arena that influences interest rates. If you want to learn more about interest rates, you can obviously read chapter 6 from there's a lot of information there I left out. I'd like to point out that this chapter is a chapter that is somewhat advanced for this class, and you will only see a few very easy conceptual questions from this material on the exam. Most of this exam will revolve around bonds, and will revolve around the next chapter, chapter 7. So thank you, class. If you have any questions, please let me know. This concludes lecture 3.1.